as we begin to look down into the disclosure forms themselves, which is really where the rubber meets the road, it's where the intention of all of the regulations sort of come to fruition for the borrower to interact with them. I want to introduce the loan estimate form to you. But before we look at it specifically, I do want to say that far and away for the majority of this, the Bureau, I think, did a very good job of retaining what worked, both from the 1974 versions of RESPA and earlier versions of TILA, and also the 2010 RESPA changes. I think they did a great job of keeping what worked and tweaking what had an opportunity to be made better. One of the key concepts from the 2010 reforms was the notion that the experience of the loan application and the experience of the closing as to what was disclosed for fees and services bore some resemblance to each other for the borrower's benefit. With that, you remember in 2010, for the first time, the good faith estimate and the HUD-1 were linked. They were brother-sister forms, is how we referred to them as we got to know them. That concept has been retained, and I think it's a good concept. I think it's a workable concept for the borrower. So first we'll introduce you to the first disclosure that is going to come to the borrower within 3 days of their loan application. This is now the loan estimate form. And so what the loan estimate form is replacing is the early TIL, again, that was received approximately at loan application, and the 2010 good faith estimate, that 3-page good faith estimate. So those two forms and a couple of other disclosures were combined and will now be represented in the new loan estimate form. The lender is going to be providing this form to the borrower, or perhaps the mortgage broker. There are two options for that, although I think you could see two providers in the case of a brokered loan. And it must be in the hands of the borrower or on its way to the borrower within 3 days of loan application, so that the timing is not significantly different there. If you remember, another concept that was introduced in 2010 was the concept of tolerance groupings or buckets. We all got a new familiarization with the concept of a bucket list. And remember, in 2010 we had the introduction of 3 buckets. We had the first group of items that could not increase. They had a 0 variation for those items. We had a second group that could increase in their aggregate up to 10%. And we had a third bucket that could increase. Those 3 buckets remain, but how they are apportioned is a little bit different. So let's talk about those. The 0 bucket, now the 0% bucket, so fees that cannot increase, now include the following. You'll see those itemized there on your screen. A broker or lender's, creditor now in the new language, a broker or lender's fees for their own services. So their own fees are in the 0% group. Also, the charges for services of an affiliate to the broker or lender. So that's new. If the service provider is an affiliate of the lender, it now counts in the 0 category, the 0% category, as if it were the lender's own charges. Also, any charges that are required for the loan and the consumer may not shop for the provider. So you might tend to think of tax, cert, flood determination, those kinds of fees, fees that are determined, that are required in conjunction with the loan, and the borrower cannot shop for the provider, and also fees for transfer taxes. Then in the 10% bucket, the fees for a service provider that are not affiliated with the lender, and the borrower selected the provider, but they were selected from the lender's provider list. Remember those official provider lists that were introduced in 2010. So if the borrower makes a selection from a provider listed on that lender's list, and the provider is not an affiliate of the lender, then fees for those services would be in the 10% grouping. And now the new grouping for the no limits on how much they can increase are fees for services that the borrower did shop for the provider, and the provider was not on the lender's list. Also fees for prepaid interest, property insurance like hazard, flood, not title insurance, but property insurance, and also escrow reserves. Also, you will see, and Ben is going to walk through the loan estimate form with you in more detail, but I think we can all applaud that the concept of a full itemization returns to both the loan estimate or the early disclosure and the closing disclosure form, which today was HUD 1. I remember in 2010 we sort of lost the concept of a full itemization of fees. Again, the mindset then was that there had been a proliferation of the listing of fees that it was confusing to the consumer. And I think that what was found in the testing was that sort of the groupings, the roll-ups, the lumpings, the fees that were not fully itemized out were actually more suspicious to borrowers. It was a lack of transparency. And the borrowers would really rather see a full accounting, a full itemization of fees for their services in conjunction with the closing. And so, yay, applause, that returns, which I think for those in the settlement world obviously becomes much more relevant when we are working to disperse the transaction. And we'll visit that a little bit more when we take a look at the closing disclosure form, but I'm going to hand the loan estimate back to Ben to walk through with you.
All right. Thank you, Mary. And so just a couple of notes here. I'm both going to sort of walk through the form in a bit of detail, but also provide a little background on the thinking behind it and why certain decisions were made to present the information the way it is. I also want to point out why an understanding of the loan estimate matters to settlement agents. And part of it is that the format of the loan estimate is, as Mary discussed, designed to be linked up to that of the closing disclosure. So they are intended to function similarly to each other, and so an understanding of one is an understanding of the other. The second is that in the upper right-hand corner of this form, you'll see a statement, save this loan estimate to compare with your closing disclosure. And that ties back to the goal of enabling comparison that I discussed earlier on. And the Bureau really does want and hope that borrowers will sit down and compare their loan estimate to the closing disclosure. And if the settlement agent is the one sitting across the table from them, you may be asked to explain a number of things. You may or may not have that information, but a working knowledge of the loan estimate is going to take you a long way. Okay, so with that, I'll point out a couple of things. So first of all, page 1 of the loan estimate, like page 1 of the closing disclosure, is really intended to be on one page all the information that a borrower really truly needs to make an informed decision about the loan. There's always more information and that could be important to certain borrowers under certain circumstances, and the Bureau made the decision not to whack essentially the majority of the statutory disclosures, or really any statutory disclosures except for the average cost or the approximate cost of funds. But what the Bureau did do is reorganize the information so that the information that consumers cared most about in testing, the information that they were most able to understand and use to make informed decisions in the testing, is the information that appears on the first page. So that if the borrower only looks at the first page of their disclosure and doesn't read any further, they have enough information to make an informed decision. So what is that information? What's prioritized here are the rate, the monthly payment, whether those amounts can change over the life of the loan, and how much money the borrower needs to bring to the closing table. That was the information that not only the Bureau's testing, but a lot of the other consumer research out there previously conducted by the Fed and HUD and by others in academia indicates are the things that borrowers use to make decisions. Are those necessarily the things the borrowers should use to make decisions? It's a point that can be debated, but the fact of the matter is, the Bureau made a pragmatic decision to, find consumers where they are rather than where one might like them to be. And so that's why you will note that the annual percentage rate does not appear on the first page of the disclosure. That was a testing-driven decision to relegate that disclosure to the back of the form because the testing indicated it was a significant source of confusion to borrowers. So very quickly, to show the way the design of this form works, there are three main categories on the form, starting with loan terms. And then below that, you'll see loan amount, interest rate, monthly principal, and interest payment. And then to the right, can this amount increase after closing? There are no's here, and then white space to the right of that. If the answer were yes, then then obviously it would say yes. And to the right, you would see additional information such as, if the interest rate can increase, how often it can increase, and how high it can go. Next to the monthly payment, how often it will increase, how high it can go, so on and so forth. And the basic concept here was that a simple loan, such as in this case a fixed rate loan, will have a form that appears more simple, and a complex loan will have a form that appears more complex. Another note here, you can see an illustration of if the loan has a prepayment penalty. In this case, you can see what it looks like. You have a yes, and you have additional information disclosed to the right. Now below that, you have the projected payments. And this is something where this is a loan with an escrow account. But what's important to understand here is even if the loan did not have escrow, you would still be populating this field below for estimated taxes, insurance, and assessments. So in other words, the lender is required to inform the borrower, even in the absence of an escrow account, of the estimated amount for taxes and insurance, and then homeowners association dues or other loan-related costs. This is a required underwriting element under the QM rule, so that information, if it's not the actual information, then the estimated information would be disclosed here. The projected payments table can have up to 4 columns of numbers, and those are intended to show the adjustments in the payment over time. Here, since this is a fixed rate loan, there are only 2 columns, and the only difference is the drop off in mortgage insurance in year 8. But if this were an adjustable rate loan, say a 5.3, the first column would be years 1 through 5, and then you'd have another column showing the change in year 8, another column showing the change in year 11, and then the remainder of the loan would all be grouped into a range in the 4th and last column. Finally, at the bottom, you have both estimated closing costs and estimated cash to close, as well as additional information on how those amounts are calculated. So why don't we go to the next page?
Yeah. Hey, Ben, real quick. I just had a couple of people that said they were having a little bit of difficulty hearing you. It's fine on my end. I'm not sure if maybe I just have the volume cranked really loudly on my computer, but maybe if you can adjust your volume just a tad.
Absolutely. I'll adjust my volume just a bit, and I'll apologize to anyone who feels like I'm shouting at them.
And real quick then, and I know we said we were going to hold questions at the end, but Janice made an observation, and I didn't do the math, but she wanted to know if there's a reason why the estimated cash to close on this form at the bottom does not equal the purchase price less loan amount plus closing costs.
The estimated cash to close. A very fair question, not one I'm afraid I can answer off the top of my head. But why don't we go to the second page, actually, which provides the breakout of how the cash to close amount is calculated?
Yeah, here we go.
All right. So again, the idea here is that anyone who wants additional detail can find it by turning the page. As Mary pointed out, you will see itemization here. as well as, however, total amounts for each subcategory. So you have both the itemization and a total amount. However, as Mary pointed out, the Bureau's testing was fairly conclusive that borrowers wanted to see the itemization. They felt like they could better trust amounts that were itemized. Now, one could debate whether that trust is justified, given that the amounts mean whatever the lender decides to call them, and they're not all itemized into subcomponents. So, but nevertheless, the idea was there's some benefit to borrowers of providing the itemization. It was something industry strongly wanted, and so the Bureau ultimately decided to go ahead with it. You'll see that these amounts are lumped into categories. These categories roughly, but not exactly, correspond to the tolerance categories that Mary discussed earlier. For instance, under loan costs on the left-hand side, under A, origination charges, these are amounts charged by the lender and are generally subject to a 0% tolerance. In other words, they cannot change barring a change in circumstances. The only amount that can be disclosed as a percent are actual discount points that reduce the rate. All other amounts are disclosed as a fee. And in the itemization, it's also worth pointing out that there's not a prescribed nomenclature beyond the fact that title fees must be preceded by the word title, and we'll be discussing that more a bit later, and that the discount points must be disclosed as a percentage of the loan amount. However, whatever you call these terms, the fees, excuse me, you have to use consistent terminology. So what you call them on the loan estimate has to match what they are called on the closing disclosure, and they have to be disclosed alphabetically within each category. Then you'll see it. The idea here is it proceeds mathematically. I will just preview, because there'll be more discussion on this later, that over on the right-hand side under other costs, under H, other, the owner's title policy is disclosed as optional. That was a controversial decision, but it is there in the final rule. And then everything is totaled up in the bottom right-hand side, coming up with the estimated cash to close amount. I will apologize in advance. I know there was a question asked before about how this calculation works, and I'd have to look at it a bit more to answer that question. Unless anyone else has a quick response, we should probably just move on and come back to that.
Well, Ben, one of the other attendees actually had an answer on page 1 of the loan estimate. So she says it does calculate properly if you take into consideration the down payment, which is reflected on page 2.
I see.
So
it's the $18,000 down payment, or is the down payment or the deposit? Okay. So in other words, see, all questions were answered on page 2.
There we go.
Okay. Well, why don't we move on to page 3? All right. And page 3, I will not dwell on, but when just as in every graduating class, someone finishes first and someone has to finish last. When you rank order the information on a form from most important to least important, something has to be at the bottom. This page 3 contains the other information. And this is not to say that this information is in and of itself unimportant, but that it was not important to many borrowers, or it's not a popularity contest, but that borrowers either did not use it when making their decisions or found it confusing when making their decisions. Or simply it didn't help them as much as other information did. So I'll just touch very briefly on what these things are. Here you see the annual percentage rate. And this is, as Cynthia touched on in the beginning, this is calculated the way the annual percentage rate has always been calculated. The Bureau did not adopt an all-in APR. So this is the same disclosure you're familiar with. The in 5 years is a modified total payments version of total payments, and it's designed to capture the first 5 years of the loan, which is the average amount of time borrowers stay in the loan. And the total interest percentage is another disclosure added by the Dodd-Frank Act. Unlike the average cost of funds, however, the total interest percentage actually tested fairly well, so it stays in the form. You have a number of other required disclosures under TILA and RESPA and ECOA. The appraisal disclosure, the servicing transfer disclosure, the assumption disclosure. The idea here was to frankly pack as many of these disclosures into this form as possible to cut down on the number of pieces of paper that would have to be provided separately. Then finally at the bottom you have a signature line. This line is optional. You are not required to include the signature line. The borrower is not required to sign the form. Many lenders, however, do want the borrower to sign the form so they can prove receipt. But you can omit the signature line. If you do omit the signature line, then you simply have to disclose up in the list above that the borrower does not have to accept the loan simply because they have signed or received the form, which is a required disclosure under the Truth in Lending Act. And so with that, I will turn it back to Cynthia.